Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast. My name is Eric McCardle. Joining me today is Will Gibson on this Wednesday, June 3rd. And Will, we're starting off the month of June with a lot of strength for domestic equities, but notably we've seen continuation of a group of stocks that have really performed well leading up to as well as throughout, and then coming out the other end of this COVID-19 outbreak and market fallout. Namely, that's the Nasdaq 100 constituency. If we look at the Invesco QQQ Trust, ticker QQQ as the name would imply, with yesterday's action returning to an all-time chart high at 235. And this is pretty remarkable given the fact that we've had so much market volatility, right? So much turbulence, and we're right back where we started in February for the Nasdaq 100. As a follow-on to this comment, we look at the recent and continued technical strength of the Qs, displaying a 5.89 fund score out of a perfect 6 with a positive score direction of 1.14. So just incredible to see tech and large growth continuing that leadership. But now we've also seen some other areas of the market that are showing strength as well. Is that right, Will?
Yeah, that's right, Eric. And I completely echo all of those thoughts. It is extremely astounding to see where we are now. Other places on the platform, as you're getting at, we are seeing some increased participation, not just from that large cap growth camp, as was previously in the past month or so, but we are seeing it across other areas of the market. A few things that we will note is some of our indicators, such as the bullish percent for the New York Stock Exchange, measuring the percentage of stocks on point and figure buy signals. This is a participation indicator, and it actually tilts a bit towards the small cap, or it's biased towards a small cap and mid cap counterparts as opposed to large cap centric discussion like we had on the Qs. So looking at that, we have seen positive movement over the past week, and coupling that, we've seen positive movement really across all major equity indicators, such as the bullish percent indicators, the positive trend indicators, our high-low indicators, as well as our 10-week and 30-week indicators. So I realize a lot of that is maybe a bit of jargon for you, but in synopsis, we're seeing participation from a relative and absolute basis across the capital markets now, really in the equity space as we're looking at right now. One point I will make on one of the indicators is going to be the 10-week for the S&P 500. So the 10-week indicator on our platform is measuring the percentage of stocks that are trading above their 10-week moving average. And as of lately, we've seen this breach the 90% threshold, meaning quite bluntly that over 90% of stocks in the S&P 500 are trading above their 10-week moving average. And again, given the historical context, that's quite astounding. And maybe some contrarians or whatnot may be thinking that's maybe a bit frothy. Maybe the market's due for a pullback or some sort of breather now. And I won't lie that we had a similar first thought. And as a result of that, we did a short study on the 10-week for the SPX. And what we found was actually positive returns following movements above that 90% threshold. One thing to note is that the returns are positive. We'll say 9 months out, we saw 96% of the cases yield positive returns for the market 9 months out. And then 2 years out, all 100% of our observations yielded positive returns. So again, appears a bit frothy, but generally we're seeing a lot of increased participation, not just from that concentrated group that we've seen previously, and we're seeing a lot of positive action on the indicators. One area in particular, as I mentioned when we talked about the bullish percent, is that small cap area. As of lately, we've actually seen some notable improvement. For example, looking at IWM, It's the iShares Russell 2000 ETF. Since posting a bottom in about the $96 range, it has since rebounded, giving a second consecutive buy signal today and recently re-entered a positive trend. So again, a lot of improvement from the small cap space, and we're seeing that evidence in increased participation across the market as a whole. Is that right, Eric?
Yeah, Will, and especially in recent trading sessions, if we're looking at the IWM ETF that we got pulled up here as it relates to, say, the S&P 500 index, SPX, since May 15th, IWM has returned just north of 13% versus the S&P 500 7.5%. And now still, on the year, IWM is still the laggard in this relationship, but seeing the participation across the equity space, that's definitely a constructive sign for U.S. stock investors. So definitely something we want to see and keep an eye on. And from the chart that we're looking at there with that breakout today, really strong formation here. You don't have overhead resistance until 154, following today's double top break at 146. And then you've got support at 138. Of course, given the weakness of the small caps relative to the rest of the global asset class and domestic equities in particular, the fund score on IWM is still, has room for improvement at 1.2. But from a purely absolute standpoint, definitely improving here in this past couple of days. Now, we've also seen some other major changes on other indicators on the platform, notably our Dolly Indicator, which is looking at underlying relative strength relationships between broad asset classes and their respective categories. And with yesterday's close, we saw fixed income overtake cash for the #1 spot in Dolly. Now, these two have been, I don't want to say trading, but placed in elevated levels among the rankings for some time now, really since the market volatility first emerged in late February, early March. And kind of duking it out up there at the top. And so with yesterday's action, we've really only seen fixed income eke out one buy signal over cash. So we don't have a huge margin there yet. Typically, we like to see a 5 signal count margin for making it actionable from some Dolly strategies, whereas others will wait until the end of the month to maintain that new fixed income exposure or overweighted position, relatively speaking. Domestic equities still in third, ticking up in buy signals. We've also seen other risk assets like commodities and international equities add a few buy signals here in recent days. So, the overall story is we're seeing the risk assets start to move up, and as they shed buy signals, we're seeing a little bit of a tug of war at the top there. Now, what's important to recognize here, Will, and Dolly, of course, we're seeing domestic equities performing well. As we mentioned, there's a lot of participation and a lot of strength, especially across the large cap space. When we're looking at domestic equities in Dolly, we're not only looking at large cap, but also mid and small. So those underlying relative strength relationships are dependent on the other size categories as well. But another way that we can look at this and maybe break it down on a little bit more of a granular scale would be at our asset class group score page. And from here, if you select the Dolly style filter in the top section and then hit set view, we're going to show you the same groups that we have in Dolly, but we're going to expand them a little bit, right? You'll notice that instead of 6, we have more than 6. I'm not going to count them out for you, but you can see a slightly elevated level there. But what's really important to identify in this case, Will, is that we've seen the S&P 500 index funds group, or what we call the U.S. equity core group, move back above a 4.0 fund score threshold. And what that means is that the group as a whole, the ETFs and mutual funds that make up the S&P 500 category, are in an optimal position from a trend and a relative strength perspective. Now, this is made even more remarkable when we consider the fact that that score direction, or looking at how the score has improved or declined in the last 6 months, is slightly positive. So again, just a testament to the fact that the core has really remained resilient here in the large cap equity space. But what's also important to note here, Will, is the strength of fixed income, right? And we talked about how it moved to the top of the Dolly rankings and has been up in the 1 and 2 spot for a few months now. Fixed income still scores very well from a group score perspective. You'll notice that we have the 2 highest scoring Dolly style groups outside of S&P 500 are both fixed income categories in the mid 3 section. And they're still outpacing all U.S. equity diversified, which really goes in line with the similar representation that you might see in the Dolly broad domestic equity representatives. Another stat to keep in mind here is, again, as we're looking at this and trying to reconcile the relationship between these 2 asset classes, of the 36 fixed income groups that are on this asset class group score page, we have 135 groups in total, 36 fixed income. 33 of them are in the top half of the rankings. So all that to say, stocks improving, on a relative basis in the near term, right? But bonds are still very, very solid here. And I don't think that you can necessarily avoid them if you're an asset allocator at this point.
That's right, Eric.
So a lot happened in the markets. We wouldn't have it any other way, right? Keeps us, going and interested. We know there's a lot happening for you all listening and for you all watching our YouTube video of this. If there's anything that we can do to help, whether it's provide clarification regarding this topic or any other topics, or if you ever just need us as a sounding board and want to bounce an idea that you have and need a second set of eyes or a second set of ears, that's what our analyst team is here for. You can reach us at 804-320-8511 during normal business hours, or you can send us an email at dwa@dorseywright.com. We really appreciate your partnership, especially in times like these. And we hope that everyone is out there, doing well and staying safe. And so with that, Will, thank you for joining me today. For the rest of you, we will talk to you next week.